For decades, conflicts like this one have been misunderstood because observers kept applying 20th century lenses to 21st century systems. Since the Cold War, power has been framed as a contest of arsenals, troop numbers, and visible deterrence. Economies were treated as backdrops, resilient enough to absorb shocks as long as the state retained control. That assumption became dogma. It blinded analysts to a structural shift that had already taken place. Modern states are no longer sustained primarily by factories and territory, but by flows. Financial liquidity, insurance confidence, logistics timing, labor predictability. These are fragile ecosystems, yet they were ignored because they do not explode on camera. Why question a model that seemed to work for so long? Why admit vulnerability when stability itself was a political asset? Ukraine understood something many capitals refused to accept. Russia's strength was built on the appearance of permanence, but permanence requires constant maintenance. Beneath the rhetoric of sovereignty and resilience sat a web of legal guarantees, energy contracts, regional subsidies, and cross-border financial dependencies. None of these are accidental. They're the result of laws governing state-owned enterprises, regulations shaping risk exposure, and fiscal mechanisms designed to keep regions compliant through predictable cash transfers. Once pressure is applied unevenly, these systems do not break cleanly. They grind. Delays cascade. Costs rise silently. This is not theory. It is accounting. The winners in this new dynamic are not soldiers or generals. They are actors who profit from volatility. Certain intermediaries, alternative suppliers, and external financiers thrive as uncertainty increases. Short-term corporate interests adapt quickly, capturing margins where state structures cannot move fast enough. The losers are long-term stability and the ordinary workforce whose livelihoods depend on predictability. Can a society remain cohesive when efficiency is permanently taxed by uncertainty? Who absorbs that cost in the end? There is, however, a major obstacle that threatens to derail this approach. Economic pressure does not respect borders. As friction spreads, allies feel it too. Inflationary shocks, energy price volatility, and supply disruptions test political unity. At what point does solidarity fracture under domestic pressure? That is the gamble. Picture an ordinary household. A worker notices overtime hours disappear. The price of essentials creeps upward. Savings meant for education or healthcare are quietly consumed by daily survival. No missiles, no sirens, just erosion. How long before frustration replaces loyalty? Globally, this tactic redraws the chessboard. It signals that future conflicts may bypass battlefields altogether, targeting systems instead of soldiers. This demands a moral reckoning. Citizens must ask whether governance exists to shield them from invisible wars, or merely manage the damage afterward. True leadership is not about winning at any cost, but about deciding which cost society should never be forced to pay. This philosophical divide did not emerge overnight. It is a product of historical paths taken after the collapse of the Soviet system, when former republics faced a choice between preserving vertical authority or experimenting with distributed resilience. Russia doubled down on centralization, convinced that coherence could only be maintained through hierarchy, legal uniformity, and obedience enforced from the top. Over time, this produced an illusion of stability. The system appeared solid because dissent was absorbed, volatility suppressed, and regional variation smoothed out by fiscal transfers and political discipline. Yet this very design carried a flaw. When all decisions converge upward, all failures do as well. Why was this ignored for so long? Because centralized systems perform well in calm conditions, and calm was mistaken for strength. Ukraine's trajectory moved in the opposite direction, often out of necessity rather than ideology. Weak institutions, repeated shocks, and chronic resource scarcity forced adaptation. Informal networks compensated for formal gaps. Decentralized decision-making became a survival skill. Over time, this created an economy and a society more tolerant of uncertainty, more capable of reallocating resources quickly, and less dependent on perfect coordination. When war came, this flexibility transformed from a coping mechanism into a strategic asset. Legal frameworks were adjusted to allow rapid contracting. Financial channels were diversified to avoid single points of failure. Supply chains were fragmented deliberately, making them harder to paralyze. The beneficiaries of this shift are those who can operate across networks rather than within rigid structures. Small operators, adaptive firms, and decentralized service providers gain relevance. The losers are large, slow-moving entities built on predictability. State monopolies struggle. Long-term planning becomes fragile. Corporate interests seeking short-term profit may thrive on volatility, but long-term national stability is tested. Can flexibility become a permanent condition without exhausting society? The counterpoint is real and dangerous. Volatility, if mismanaged, can turn inward. Inflation, regulatory ambiguity, and uneven enforcement risk eroding trust. Flexibility can slide into fragmentation. At what point does adaptation become instability? Consider the everyday reality. A shop owner adjusts prices weekly, not out of greed but survival. A worker changes jobs more often, not for opportunity but necessity. Life becomes a sequence of recalculations. This resilience has a cost. On the global stage, this clash signals a shift away from dominance through mass toward influence through disruption. It challenges traditional power structures and unsettles markets worldwide. The moral question is unavoidable. Should power be measured by control or by the ability to absorb change without breaking the social contract? Citizens must demand leaders who understand that stability imposed from above is fragile, and that true strength lies in systems designed to bend without snapping. This shift only makes sense when placed against the historical refusal of states to admit how exposed their economic circulatory systems have become. For decades, sanctions, trade rules, and financial regulation were treated as diplomatic afterthoughts, secondary to military deterrence. Governments assumed these tools were blunt and slow, incapable of shaping real outcomes in wartime. That miscalculation created a blind spot. Russia's post-Soviet reconstruction tied its power not just to territory, but to efficiency. Energy exports priced through long-term contracts, logistics optimized for scale, insurance pools calibrated for low-risk continuity, and regional labor markets stabilized through predictable industrial output. All of this worked beautifully as long as friction remained minimal. Why would anyone imagine these systems could be turned into liabilities? Ukraine did. The technical execution was methodical. Regulatory pressure altered shipping risk profiles. Targeted disruptions changed delivery timelines just enough to invalidate insurance assumptions. Energy pricing volatility, amplified through legal market mechanisms, complicated regional budget forecasting. Labor dependencies restrained as delays forced factories to idle intermittently, triggering temporary layoffs rather than outright closures, a subtle but devastating distinction. None of these actions violated international law. They exploited it. The system was not attacked head-on. It was forced to operate outside its optimal parameters day after day. Efficiency losses accumulated quietly, invisibly, relentlessly. The immediate winners are those positioned to arbitrage disruption. Alternative transport routes, niche insurers, short-term commodity traders, and external service providers profit from instability. The losers are structural. State-linked giants bleed margin. Regional governments face rising obligations with shrinking revenue certainty. Workers become buffers, absorbing shocks through reduced hours and frozen wages. Who speaks for them when pain is diffuse and accountability blurred? Yet this strategy carries a profound risk. Friction does not discriminate perfectly. Spillover effects threaten allies, partners, and even Ukraine's own economic resilience. Excessive pressure can provoke consolidation rather than collapse, pushing systems to adapt defensively. What if the target economy restructures faster than expected? What if inefficiency becomes normalized? Look at the human scale. A truck driver waits longer for assignments. A technician sees bonuses disappear. A family postpones major purchases, not because of fear, but because numbers no longer add up. This is how pressure is felt now. Not through fear of bombs, but through uncertainty creeping into daily arithmetic. How long before patience runs out? Globally, this marks a transition towards systemic warfare, where legality becomes a weapon and markets are the reign. The ethical burden shifts. Citizens must ask whether leaders are prepared to defend social cohesion, not just strategic objectives. Power exercised without visible violence still carries responsibility. A society deserves governance that understands not only how to apply pressure, but when restraint becomes the truest measure of strength. This gray zone exists because for generations, economic stability was treated as a civilian constant, something wars disrupted but never deliberately engineered against. After the Second World War, global institutions were built on the assumption that finance, insurance, and labor markets should remain insulated from direct conflict. That separation became a norm, then a myth. As economies globalized and digitized, states grew more dependent on uninterrupted liquidity and confidence-based systems. Yet policymakers continue to behave as if these mechanisms were neutral and untouchable. Why confront a vulnerability that underpins your own legitimacy? Ukraine's approach dismantles that illusion with precision. Modern states run on cash velocity. Money must circulate to fund payrolls, maintain infrastructure, and service debt. Insurance markets function on probabilistic stability, assuming that disruptions are rare and localized. Labor compliance depends on wages arriving on time and in full. By introducing calibrated uncertainty, Ukraine forces every one of these systems to recalculate risk daily. Insurance premiums rise not because assets are destroyed, but because predictability vanishes. Transport delays multiply as compliance checks, rerouting, and contract renegotiations become routine. Regional budgets strain as revenues fluctuate, while obligations remain fixed by law. The beneficiaries of this environment are few and agile. Speculators and short-term financiers thrive on volatility. Certain intermediaries capture premiums for managing risk others can no longer bear. The losers are broad and structural. Long-term investment retreats. Public services absorb cuts quietly. Workers lose bargaining power as insecurity becomes normalized. Who benefits when fear replaces planning? The obstacle is that prolonged economic pressure can harden rather than weaken political resolve. States under stress may centralize further, suppress dissent, and sacrifice efficiency for control. There is also the danger of escalation into retaliatory economic warfare, expanding the damage beyond the original target. Can societies endure permanent uncertainty without demanding change? At ground level, the impact is mundane and devastating. A regional official delays infrastructure repairs. A hospital postpones equipment upgrades. A household stretches its budget, cutting quality before quantity. No headlines, no alarms, just a slow recalibration of expectations downward. How many compromises can people make before trust erodes? On the global stage, this tactic challenges the very architecture of economic governance. It reveals how interconnected systems can be weaponized without firing a shot. The moral question sharpens. If wars are fought through livelihoods, then leadership must be judged not only by strategic success, but by its willingness to protect the social fabric. Citizens are entitled to more than survival. They deserve foresight, accountability, and a refusal to treat economic suffering as an acceptable collateral damage. For most of modern history, leaders relied on a dangerous assumption. They believed populations could be mobilized indefinitely as long as suffering felt collective and distant from daily choice. Wars were endured because hardship was framed as sacrifice with a visible endpoint. What has been ignored for decades is how profoundly that social contract changes when economic stress becomes individualized, fragmented, and endless. When instability no longer arrives as a shock but as a routine inconvenience, it stops feeling heroic. It starts feeling personal. Why was this misunderstood for so long? Because spreadsheets never capture dignity. The mechanics are brutally simple. A factory loses insurance coverage or sees premiums spike beyond viability. Management does not announce closure. It trims hours. Temporary contracts are not renewed. Overtime disappears. Official employment numbers remain intact while income quietly shrinks. Regional governments facing unpredictable revenues are bound by law to maintain core services, so they freeze wages instead. Inflation absorbs what little flexibility remains. None of this requires repression. Compliance is achieved through arithmetic. How do you protest when missing a paycheck risks everything? There are winners, but they are distant and abstract. Corporations with diversified exposure adjust. Financial actors profit from hedging and volatility. The losers are visible in every household budget. The worker whose savings were meant to buffer risk discovers that buffers were designed for stability, not erosion. Loyalty shifts. Ideology fades. Survival becomes transactional. How long would you stay committed to a system that cannot guarantee predictability? The obstacle is that this pressure does not automatically translate into political change. Economic pain can breed resignation as easily as resistance. Fear isolates. People adapt downward. They accept less, expect less, demand less. That is the silent danger of this tactic. It weakens not only the target state, but the social muscle required to reform it. Imagine the daily ritual. A parent recalculates grocery choices, a postponed medical visit, a decision not to repair, but to endure. These are not dramatic moments, but they accumulate. Each compromise subtracts a little from trust. Globally, this signals a shift toward conflicts fought through civilians rather than over them. It forces a moral reckoning. If pressure replaces persuasion, what remains of legitimacy? Societies must ask whether endurance without representation is strength or merely submission. True governance is not measured by how much pain people can absorb, but by how rarely leaders ask them to. This assumption of endurance has deep historical roots. Empires survived sieges, rationing, and even devastation because hardship was centralized and meaning was controlled. The state absorbed shock and redistributed it in ways that preserved the illusion of coherence. For decades, analysts believed that as long as institutions functioned, societies would follow. What they underestimated is how modern governance depends less on authority and more on credibility. When systems promise predictability and deliver uncertainty, legitimacy erodes quietly. Why was this ignored? Because cohesion was measured through obedience, not confidence. Ukraine's wager is calculated. Distributed stress fractures systems differently than concentrated trauma. Bombs unify through fear. Economic uncertainty isolates through calculation. Every official forced to reallocate funds, delay payments, or reinterpret regulations faces a choice that chips away at institutional trust. Covering losses preserves appearance but drains resources. Admitting failure invites scrutiny and career risk. These micro-decisions accumulate, creating a culture of short-term survival rather than long-term strategy. When governance becomes reactive, vision collapses. Can any system thrive when every decision is defensive? The immediate beneficiaries of this environment are not states, but opportunists. Contractors inflate costs. Intermediaries exploit bottlenecks. Short-term fixes replace structural planning. The losers are institutions designed for continuity. Long-term projects stall. Public confidence thins. Workers sense the shift before statistics do. When future planning disappears, loyalty follows. Yet there is a counterforce that could blunt the strategy. States under pressure may externalize blame effectively, redirecting frustration outward. Propaganda can reframe erosion as resilience. Repression can silence dissent. Economic suffering does not guarantee accountability. It can entrench power as easily as undermine it. What if the system adapts by hardening rather than cracking? At the human level, the effect is subtle and corrosive. An administrator signs off on delayed pensions. A manager accepts lower quality inputs. A family postpones education plans. Each decision feels rational in isolation. Together, they redefine what normal looks like. How many adjustments does it take before ambition gives way to resignation? Geopolitically, this approach signals a shift from decisive victories to prolonged contests of credibility. It challenges the notion that power is demonstrated through force alone. The moral implication is unsettling. If mistakes emerge not from grand failures, but from accumulated compromises, then responsibility becomes diffuse. Citizens must demand governance that resists erosion, not merely manages decline. True strength lies in systems that protect trust even under pressure, because once trust is gone, recovery becomes far more costly than any battlefield loss. This danger has been quietly building for years, masked by the comforting language of globalization and efficiency. Since the late 20th century, societies were encouraged to believe that interdependence itself was a guarantee of peace. Supply chains stretched across continents. Financial systems merged into a single bloodstream. Labor markets adjusted to global rhythms. What was rarely discussed is that efficiency removes redundancy, and redundancy is what protects societies under stress. Fragility was misread as optimization. Why invest in buffers when markets reward speed? The mechanism that makes this tactic powerful is the same one that makes it universal. Insurance relies on shared risk assumptions. Markets rely on confidence that contracts will be honored tomorrow as they were today. Labor systems rely on the belief that effort will be rewarded predictably. Once uncertainty becomes deliberate rather than accidental, these foundations shake. Risk premiums rise everywhere, not just at the target. Capital becomes cautious. Long-term investment retreats. The invisible tax of fear spreads far beyond the original conflict. The winners in such a world are not nations, but entities that thrive on disruption. Large financial actors capable of hedging volatility, corporations with global mobility, and platforms detached from physical infrastructure gain leverage. The losers are societies anchored to place. Workers, small businesses, and public institutions bear the cost of instability they did not choose. Does anyone vote for fragility? There is also a profound obstacle. If every state begins to weaponize interdependence, the system may not survive repeated shocks. Retaliation becomes normalized. Trust evaporates. Global cooperation degrades into transactional suspicion. What happens when every crisis triggers economic warfare? At what point does protection become isolation? Picture the ripple effect. A pension fund reallocates assets away from perceived risk. A government increases borrowing costs to maintain confidence. A household faces higher interest rates without understanding why. The cause is distant abstract, but the impact is immediate. This is how systemic weapons work. They dissolve accountability. On the geopolitical stage, this marks a transition into an era where power is exercised through vulnerability rather than dominance. The ethical stakes are immense. If fragility becomes a strategic asset, leaders may be tempted to exploit it rather than reduce it. Citizens must demand the opposite. Governance in this new age must prioritize resilience over efficiency, cooperation over coercion, and long-term stability over short-term leverage. Because a world that treats economic pain as a weapon will eventually discover that no society is immune. This question has lingered unresolved because modern governance has learned to speak the language of protection while quietly outsourcing risk. For decades, citizens were told that security meant borders held, currency stable, institutions intact. What was rarely acknowledged is that security also means predictability in daily life. The confidence that effort today will not be erased tomorrow by forces beyond comprehension. When wars migrate into balance sheets and labor contracts, that promise fractures. Why was this never debated openly? Because uncertainty is easier to impose than to explain. The technical reality is stark. When states choose strategies that export volatility, they are making a governance decision as much as a strategic one. Laws governing fiscal responsibility, emergency powers, and market regulation suddenly become instruments of pressure rather than shields for citizens. Infrastructure is maintained just enough to function. Social contracts are stretched without being rewritten. Accountability diffuses into committees and technicalities. Victory becomes measurable. Responsibility does not. Who carries the weight when outcomes are declared successful but lives feel diminished? There are beneficiaries in this moral ambiguity. Leaders gain leverage without mobilizing populations openly. Institutions preserve authority by framing hardship as inevitable. Certain economic actors profit from managing uncertainty rather than eliminating it. The losers are those without buffers. Workers whose futures depend on stability rather than agility. Families whose planning horizons shrink from decades to months. Is resilience still resilience when it is coerced? The danger lies in normalization. When citizens accept invisible warfare as the cost of modern power, expectations recalibrate downward. Transparency becomes optional. Consent becomes assumed. The obstacle to justice is not ignorance, but fatigue. People adapt. They stop asking who decided. They stop believing answers matter. Imagine a generation growing up where volatility is permanent, where savings feel provisional and careers temporary by design. That is not collateral damage. That is policy consequence. And once embedded, It reshapes politics itself. Populations under constant uncertainty do not demand excellence. They demand relief. Globally, this moment redraws the moral map of power. If influence is measured by who can absorb chaos and who can export it, then leadership must be judged differently, not by dominance, but by restraint, not by victory narratives, but by social outcomes. Citizens deserve more than strategic success achieved in their name. They deserve clarity about risks imposed, limits respected, and futures protected. Governance worthy of trust does not ask its people to quietly endure what they never agreed to bear. History does not punish defeat alone. It punishes those who confuse winning with governing and forget that power without accountability always returns its bill with interest.